Do you want to invest in cryptocurrency, or are you simply curious about its potential as a financial asset? Find out what the experts advise. The origin of cryptocurrency is shrouded in mystery. In the wake of the financial crisis of 2007 to 2008, when much of the world was still reeling from the crash and wallowing in recession, the first digital asset was introduced to the world. This was Bitcoin, launched in 2009 by a mysterious party who calls himself Satoshi Nakamoto. He is referred to by male pronouns, but that's only because he introduced himself online as a middle-aged man living in Japan. The pseudonym could easily belong to anyone or to a group of people acting as a collective. Multiple attempts have been made to uncover Nakamoto's identity. Some people have even fooled prominent publications or law enforcement officials into thinking that the real Nakamoto has been identified. Inevitably, however, these fake Nakamotos are revealed to be frauds. To date, no one knows who or where Nakamoto is. What we do know is that Bitcoin's launch in 2009 was inspired by the ongoing global financial crisis that began in the United States in 2007. In their book Crypto Assets, published a decade later, Chris Berniske and Jack Tatar explained that Nakamoto published a white paper expounding his concept for a secure, decentralized online currency in 2008. That same year, American investment firm Lehman Brothers filed for bankruptcy. The subprime mortgage crisis was well underway, and was soon to bloom into what became known as the Great Recession. For Nakamoto, the economic hardships facing the United States proved the need for an electronic trade system that relied fully on hard math, instead of trust between consumers and financial institutions. Bitcoin, he argued, was not just an alternative for existing monetary systems, it was meant to replace them altogether. Indeed, champions of cryptocurrency hail digital assets and the platforms that distribute them as the financial systems of the future. For enthusiasts, these online currencies represent an opportunity for monetary transactions to be secure, democratic, and unhindered by government restrictions. So far, however, Bitcoin and other forms of cryptocurrency have not become popular options among everyday consumers. Several countries have either cautioned against cryptocurrencies or have placed restrictions on them altogether. Financial experts recommend that investors buy with caution, if at all. Cryptocurrency optimists believe that decentralized, digital currency may one day replace government-issued tender. At the moment, however, the future of the cryptocurrency market is uncertain. Nakamoto clearly valued caution during Bitcoin's infancy. In 2010, the virtual coin could have become the currency of choice among WikiLeaks supporters, who had been blocked by major credit card companies from funding the website. Nakamoto, however, begged WikiLeaks not to accept the cryptocurrency as a payment method. He warned that if too many people attempted to use Bitcoin during its beta stage, its software could have been overwhelmed. Nakamoto also worried that the association with WikiLeaks might invite international scorn and government regulation attempts before Bitcoin could grow to a more sustainable stage. Shortly after issuing his plea, Nakamoto vanished from the virtual scene. Since then, Bitcoin and other cryptocurrencies have become assets that are regulated by community consensus. Traders, miners, and others involved in cryptocurrency use debate to agree on any broad changes to the system, a process that has so far reinforced Bitcoin's status as a decentralized currency. However, Nakamoto is still an important player in the cryptocurrency market overall, and for Bitcoin traders specifically. In 2017, analysts estimated that Nakamoto owned 5% of all Bitcoin, making him the single largest holder of the currency. If he wanted to, Nakamoto could release all the cryptocurrency he owns and flood the market, tanking Bitcoin's value. His share of Bitcoin is proportionally larger than the amount of gold owned by the US government, giving him influence over Bitcoin's economy on par with the federal agency. Nakamoto's secret identity and his subsequent retreat from online forums were not the only factors that gave digital assets a secretive, even nefarious reputation. Bitcoin specifically gained an association with criminal activity after it was chosen as the primary currency for Silk Road, an application that granted access to a decentralized online marketplace. Named for an ancient network of trade routes that connected eastern and western territories, the Silk Road quickly became a black market, providing anything a consumer might wish for, legal or not. Once media outlets began writing about Bitcoin's use on Silk Road, the cryptocurrency began shooting up in value. Bitcoin's price rose even more sharply when the Republic of Cyprus was bailed out of its economic crisis in 2013. The bailout was viewed by crypto enthusiasts as proof that a digital, decentralized currency could prove more stable than a form of money backed and directly influenced by government. Bitcoin soared to a valuation of $1,000 per unit in late 2013 due to its budding popularity in China. But its momentum there was halted abruptly. China began restricting use of Bitcoin, insisting that the digital asset not be treated as a true currency. The U.S. Federal Bureau of Investigation also shut down the Silk Road and arrested its creator. Between 2013 and 2015, Bitcoin slowly depreciated in value. However, it continued to attract new enthusiasts, some of whom fiercely debated whether a cryptocurrency's value needed to be strictly limited to its use as an alternative monetary system. Bitcoin's true asset, these fans argue, was blockchaining, the technology that allows cryptocurrencies to complete and store transactions. As Bernice and Tatar explain in Crypto Assets, the word cryptocurrency might describe any form of digital tender that can be traded online in exchange for goods or services in lieu of more traditional forms of money. A key difference between cryptocurrencies and other monetary units is that most are decentralized, meaning that they are not authorized, regulated, or controlled by any one authority. And most traditional crypto enthusiasts continue to balk at attempts to regulate the market. Buying cryptocurrencies can still be a risky endeavor, but learning how they function can help investors understand how digital economies are challenging and changing existing financial institutions. Online discussions surrounding Bitcoin and other digital currencies tend to be heavy with jargon. Most of the words have existed for a decade or less and haven't achieved mainstream usage. But with a little bit of patience, cryptocurrency and the technology that enables its use can be easily understood. Cryptocurrency coins are created through a process called mining. This process requires powerful computers capable of processing numbers at a rapid rate. When a transaction is processed in Bitcoin servers, it's gathered together with thousands of other recently created transactions. These blocks of transactions are then translated into an encrypted string of numbers and letters called a hash. Hashing makes it difficult to change the information contained in the transaction block. Miners are tasked with guessing the hash of the next block that needs to be verified and linked to its predecessors. The only way to guess the hash is to use a computer that will generate strings of numbers and letters until it finds the correct combination. Miners vie for the opportunity to determine the next block's hash because the first to do so is automatically rewarded with a set amount of cryptocurrency. This reward method enables cryptocurrency platforms, otherwise known as blockchain architectures, to create a sufficient supply of coins that can later be used for trading. It also rewards those who participate for their help in growing the cryptocurrency. Mining is a technical and sometimes expensive activity for those who engage with it. Dedicated miners frequently sink thousands of dollars into machines that can perform the task. When miners hash a block of information, the block is added to a chain. This process, called blockchaining, links the block of information to all blocks that came before it and all blocks that will come after. Blockchains typically record cryptocurrency transactions across multiple computers in a way that ensures permanent documentation of any sale, purchase, or transfer. If hackers or other nefarious people wanted to tamper with a cryptocurrency transaction, they would need to alter not only the block containing the relevant transaction, but all the blocks that came after it. Since new blocks are added at a constant rate, changing a blockchain is a theoretically possible but practically impossible task. Essentially, blockchains provide an ongoing, verifiable history of a cryptocurrency's use that is virtually tamper-proof. While blockchains record any transactions enacted through a cryptocurrency, private information transferred during those transactions is still protected. Transfers, purchases, and sales are encrypted so that only the receiving party can read the information being sent. Like all currencies, cryptocurrencies depend partially on scarcity to maintain their value. For this reason, most blockchain architectures reward a progressively smaller amount of cryptocurrency units to miners over time. For example, Bitcoin paid miners 50 units for each block completed when the cryptocurrency was first released. 4 years later, however, that reward was cut in half. The same happened again 8 years after its release. By 2020, Bitcoin miners will be paid only 6.25 Bitcoin for each block they complete. Eventually, most cryptocurrencies plan to compensate miners by paying them in transaction fees, instead of providing direct amounts of the digital asset in question. Switching to transaction-based compensation will cut out the need to generate new cryptocurrency, theoretically ensuring a low and steady inflation rate. Bitcoin may have been the first cryptocurrency, but it didn't remain the sole market contender for long. Some cryptocurrencies competed directly with Bitcoin. Litecoin, for example, was an early alternative that promised users a faster payment processing time. Instead of taking 10 minutes to add a new block to an existing chain, Litecoin miners only had to work for less than 3 minutes. The speedier payout time proved attractive to vendors who did not want to deal with Bitcoin's slower processing speed. Not every cryptocurrency, however, was created with the intention of replacing existing financial systems. Some were launched with the hope of creating other decentralized services. Namecoin, for example, was created to provide internet users with private, unregulated websites that could remain unregistered with government authorities. Ethereum, another cryptocurrency, launched with the intention of creating an asset that could be used to easily purchase, trade, and access software. Dogecoin, a cryptocurrency inspired by a viral internet meme, started largely as a joke, but later became a digital fundraising method for online philanthropic campaigns. Since cryptocurrencies are not always created as an alternative to legal tender, Bernice and Tatar have suggested that the overarching term cryptocurrency be replaced with cryptoasset. That term would more accurately describe blockchain architectures like Namecoin, where units are traded only to purchase a digital good, while still encompassing more traditional cryptocurrencies like Bitcoin. After Bitcoin's value began tanking in 2014, some financial analysts and technological experts began questioning whether the blockchaining process, rather than Bitcoin, had actually been the valuable innovation all along. In particular, professionals began looking into the potential boons that private blockchains could provide to the business sector. Blockchains can operate under public or private systems. In private blockchains, a native asset like Bitcoin isn't necessary. The computers are all within the same trusted system, and the blockchain is used to speed up existing processes and save money. A bank, for example, could use a private blockchain as a faster and more secure system for recording deposits and withdrawals. It would not need to pay miners to ensure that process was completed, since completing the process would reward the bank by lowering the cost of documenting fiscal activity. Public blockchains, however, do need to incentivize miners to propagate the system. For those blockchains, a crypto asset unit is an essential component for participation, even if the blockchain architecture in question isn't aiming to become a contender for a new global currency. At the moment, cryptocurrency enthusiasts can only invest funds in public blockchains. Private blockchains have provided businesses with a secure way to document and transmit information, but they have not yet yielded an asset that appeals to the public trading sector. In late 2017, Bitcoin seemed like a risky bet that was about to pay off big. The cryptocurrency had skyrocketed in value over the course of just a few months, attracting a flood of new investors and delighting longtime enthusiasts. By mid-December, one Bitcoin was worth an astonishing $17,000. Around the same time the year before, it had been worth less than $1,000. One professional analyst predicted that a single Bitcoin would soon be valued at $100,000. Two futures markets for Bitcoin opened. After years of skepticism on the part of financial and economic experts, cryptocurrency was finally exciting mainstream enthusiasm. But just as quickly, Bitcoin's value began falling again. In 2 months, the cryptocurrency dropped below $8,000. By December 2018, a single coin was worth less than $4,000. If an investor bought a coin at the currency's $17,000 peak, that investment would have lost more than 75% of its value. Faith in the future of cryptocurrency had been shaken by a series of events, including government pushback against all online forms of cryptocurrency in South Korea. The United States Securities and Exchange Commission also mandated that the creators behind cryptocurrencies register their digital distribution platforms with the SEC. Many of Bitcoin's core users, who had championed the currency for years, began backing away, turned off by the threat of increased regulation. Other investors who had contributed to the 2017 spike began selling off, eager to preserve their winnings or mitigate their losses. Bitcoin's fast rise and plummet in 2017 was not unusual. Speculation-driven spikes and crashes have been a hallmark of cryptocurrencies since Bitcoin was first introduced. But to date, Bitcoin has not recovered the gains it experienced during its 2017 bull run. In March 2019, a single coin was valued at $4,000. At just over a decade old, cryptocurrencies are still an emerging technology, with plenty of room for growth and change. As an investment asset, however, cryptocurrencies are still largely speculative purchases. Those who choose to buy Bitcoin or other digital assets may find their fortunes soaring in the coming decades. Alternatively, they may discover that the currency they initially found so promising has disappeared entirely. Renowned investors, like Warren Buffett, have warned conservative investors to steer clear of cryptocurrencies altogether, asserting that since the coins lack any intrinsic value, their worth is entirely dependent on finding purchasers who are willing to pay a higher price than the previous buyer. At the moment, investing in cryptocurrencies can be compared to the dot-com bubble, when the stock market rose and subsequently crashed as investors poured money into a host of online startups. It's easy to look back at that economic period and claim that those who bought stock in major companies like Google and Amazon were smart investors with keen insight into future trends. In truth, it was unclear at the time which online companies would survive the crash and which would falter. Likewise, it's hard to predict which, if any, cryptocurrencies will survive the digital market's second decade of existence. If an investor does choose to buy cryptocurrencies, it's important to remember that the digital assets are valued differently than traditional investments like stocks and bonds. Cryptocurrencies might be launched by companies, but they are not companies in and of themselves. Therefore, digital assets are not valued based on the company's current holdings or its future earnings potential. Bernice and Tatar recommend that cryptocurrency investors judge each crypto asset as if it were a commodity, like steam, electricity, or coal. To begin, the commodity's appeal to the broader market and its sustainability should both be considered. Investors should also weigh whether the particular commodity would benefit from a decentralized distribution system. Next, a prospective investor should look for the cryptocurrency's white paper, which will explain why it was created and how it will function. Overly vague white papers might indicate crypto assets to be avoided, as they may merely be a scam. Online communities such as Reddit and Twitter can provide crypto enthusiasts with additional venues for vetting cryptocurrencies and the teams who create them. A potential investor should carefully consider whether the cryptocurrency's value is determined partially through utility or fully through speculation. Bitcoin, for example, is valued partially through utility because it provides an in-demand service, affordable, fast, and decentralized monetary transfers. Finally, an investor should consider how quickly or slowly the cryptocurrency is issued and how many units will be issued overall. The value of a cryptocurrency cannot be determined based on its listing price alone. A coin with a fast release rate and a higher unit cap, like Litecoin, would be worth less proportionally than Bitcoin. Ultimately, savvy investors should be aware of placing the bulk of their savings in any new, unproven market. If cryptocurrencies prove to be a stable monetary alternative in the future, then investors will have plenty of opportunities to benefit from their future growth. Early adopters will benefit more, but only if they back the correct crypto assets. Until it is adopted on a larger scale, buying a cryptocurrency is at best a hobby for technology enthusiasts. For everyone else, engaging in the market is most comparable to gambling and should be